The early 1980s marked a period of significant economic change and upheaval. The world was transitioning away from the post-World War II economic order. This period saw the rise of new economic powers. Global trade expanded rapidly. New technologies emerged, changing the way business was conducted. Amidst this backdrop of transformation, there were underlying vulnerabilities in the global economic system. Inflation had become a persistent problem in many countries. Interest rates were rising as central banks tried to control inflation. The global debt burden was increasing, particularly in developing countries. These factors created a fragile economic environment. It was vulnerable to shocks. The stage was set for a period of economic instability. This instability would have far-reaching consequences. By the early 1980s, several economic indicators signaled trouble ahead. Inflation, a sustained increase in the general price level of goods and services, was a growing concern in many developed economies. This erosion of purchasing power created uncertainty for businesses and consumers alike. Another red flag was the rising unemployment rate. As economic activity slowed, businesses began to lay off workers, leading to increased joblessness. The unemployment rate serves as a key indicator of economic health, and its rise pointed to a weakening economy. Furthermore, interest rates were climbing. Central banks, tasked with maintaining price stability, responded to inflation by raising interest rates. While intended to curb inflation, higher interest rates made borrowing more expensive for businesses and consumers, further dampening economic activity. These warning signs, like tremors before an earthquake, hinted at the economic turmoil that lay ahead. While various factors contributed to the economic downturn of the 1980s, policy decisions played a significant role. One notable example was the shift towards monetarist economic policies, particularly in the United States and the United Kingdom. Monetarism, championed by economists like Milton Friedman, advocated for controlling inflation by managing the money supply. This approach led to tight monetary policies, including high interest rates aimed at curbing inflation. While these policies did help to bring inflation under control, they also had the unintended consequence of triggering a recession. The sharp rise in interest rates increased borrowing costs, making it more expensive for businesses to invest and for consumers to spend, thereby slowing economic activity. Moreover, some argue that supply-side economics, also known as trickle-down economics, contributed to the economic problems of the 1980s. This theory posits that reducing taxes, particularly for corporations and high-income earners, will stimulate economic growth. However, critics contend that these tax cuts primarily benefited the wealthy, exacerbated income inequality, and did little to boost overall economic growth. The 1980s economic crisis was not solely a product of domestic policies. External shocks, particularly in the energy sector, also played a role. The decade began with the lingering effects of the 1979 energy crisis. Triggered by the Iranian Revolution, this disruption in global oil supply led to a surge in oil prices, fueling inflation worldwide. In 1980, the Iran-Iraq War further exacerbated the situation. The conflict disrupted oil production in both countries, which were major oil exporters, leading to another round of oil price spikes. These oil shocks had a ripple effect throughout the global economy, driving up production costs for businesses and increasing prices for consumers. The combination of high oil prices and inflation created a difficult economic environment. Central banks faced a dilemma: raise interest rates to combat inflation, risking a recession, or keep interest rates low, potentially exacerbating inflation. This difficult balancing act, coupled with external shocks, contributed to the economic instability of the early 1980s.